Good afternoon, Benedict.
Good afternoon, Professor. Just had to connect my headphones, sorry.
I'm good. Good afternoon, everyone.
Good afternoon, Professor.
Good afternoon. Wow. Ellie is enjoying the sunshine, listening. Yeah, she's sitting on the bench with one leg, with one leg folding. Ellie, you are from, Ellie, you are there? Ellie Nguyen. Good afternoon, everyone. Hey, Sebastian, the Benedict, have you heard about the Faroe Island? Benedict?
No, I haven't.
No, Faroe Island is located just above the Denmark. This picture is, the Faroe Island is part of Denmark, actually. But as far as I understand it, Faroe Island is also its own independence. So anyway, this picture is taken from the Faroe Island. So the reason why I ask you is that this place is maybe pretty close to Germany. That's why. Yeah. So, anyway, yeah. Let's wait others to join. I understand many Germans love spending their holidays in Italy rather than in the northern part of Europe, right?
I think there's both, but yeah, there are many people going to Italy. But I think there are a few people also going to Denmark and to the north.
But the favorite place for summer vacation is probably in the southern area, right, rather than northern area.
Yeah, definitely.
Yeah. Okay. Yeah, first of all, everything is about risk and return. So when you talk about anything, any concept from corporate finance, you should already think of a risk and return. And risk, we have many types of risk, right? One could be financial, for example, the credit risk or liquidity risk or political risk or legal risk, financial risk, accounting risk, all sorts of risks. We have all sorts of risks in terms of when it comes to the financial market. But how about return? So then return is gonna be, if you made investment in equity, then return will come in the form of dividends, or if you sell the stock, it will come in capital gains, right? Or you may sometimes lose, then you're gonna have a capital loss, right? So when it comes to bonds, the return is going to be coupon payments, right? Then the interest rate, the yield, the yield to maturity, which we talked about last lecture, is all about risk. So, but in another way, we also say the required return, right? In the question, what is the required return of whether required return is the same as yield to maturity? Yes, it is. So it's kind of the both sides of the coin. So risk return should reflect all the risks, right? So when you make investment in bond, all the risks that is embedded in the bond issued by a company should be reflected into the yield to maturity, right? Interest rate, yield to maturity, or required return. So at the end of the day, the valuation actually means that whether the required return or yield to maturity when it comes to bond investment fully reflect all the risks contained in the bond or issuance of the bonds, issuer of the bonds, right? But at the end of the day, the real risks of the bond comes from the issue of the bond, right? So, yeah. So the risk, the yield to maturity, which is the return, expected return or a required return from the bond you want to make, from the bond you want to purchase, is the no other than the reflection of the risks, right? So based on your own judgment, based on your own understanding, based on your analysis of the risks of the bond, your discount rate could be higher or lower than the sometimes than the yield, than the current market current yield of the bond, because all the investors has different ideas about the risks of securities, right? Okay, it's getting much more complicated. Anyway, I'm going to elaborate further as we move on.
Professor?
Yeah.
Sorry, I think you're not sharing the screen.
Sorry, could you say again? Could you say again?
I think your screen is not currently sharing.
I didn't catch your comment. Sorry. You are saying Evgeny?
Oh, yeah, now we can see.
Okay. This is the first slide. Okay, so lecture 8, understanding and valuing equities. Okay. Yeah. So just a little bit the time for the review of previous lecture. So yesterday, the Federal Bank in the US raised interest rate by 0.7 percentage point for third straight meeting, which means that the federal funds rate has become, I think, the 3.3 not this, probably 3.0 to 3.5 the target interest rate. So anyway, the federal bank raised the base interest rate by three quarters. So it means that the interest increase in interest rate has the impact on the overall financial market. So this is the this was the yield maturity for 10-year treasury bond last Tuesday, right? But now it has become 3.534% as a result of the fund raising the interest rate. So price has previously 93.8125, but now it is 93.5. So it decreased. Why? Because it has increased. So coupon rate is same as before, right? And maturity is same. So if you can also calculate this yield maturity using the Excel. Okay. A relationship between bond price and the bond characteristics. So clearly, the bond price is inversely related to the bond market discount rate, or we call it yield to maturity or required rate of return, right? When the market discount rate increases, bond price decreases. Inverse impact. Okay. Price, interest rate, inverse. Okay. Inverse relationship. This is very important because the interest rate is supposed to discount the cash flow. Okay. For the same coupon rate and time to maturity, the percentage price change greater in absolute term when the market discount rate goes down. Okay, so when the market discount rate goes down, the level of change is higher than market interest rate goes up. So it means that when market discount rate goes down, compared to the decrease in rate, the change of a price is much higher. So as you can see, this is price, this is interest rate. Okay, market discount rate. So this is getting higher interest rate, higher price. You see, let's say we are now here. So if interest rate is decreases, right? Goes down. If interest rate goes down, price is supposed to goes up, right? If interest rate increases, then price supposed to goes down, right? So price supposed to goes down. Okay, but the level of increase or level of decrease is different. So when the interest rate goes down, let's say we first here, and the interest rate goes down, and the price if we here, then price may be here, right? So then this is change, right? But why? But when interest rates goes up, we are here, and the price would decrease, right? So then let's say we are here. Similar about here, right? So, right. So let's assume that the level of degree, the level of interest rate, the change of interest rate is the same, right? This one is the same. The level of decrease and level of increase is the same. Let's assume that. Then if the interest rate decreases, then price is supposed to goes up. But the level of increase in price is is higher than the level of decreases. So why? Okay, this is cash flow, right? So actually, the value of the bond is based on the discounting of the cash flow. So let's say cash flow is 2, and interest rate initially 1 point. Okay, so then it's gonna be the value of, we have only one cash flow. Let's assume that. Then the price of the this bond is gonna be 1, right? But let's assume that this interest rate has decreased from 1 to 0, right? So then price is going to be 2, right? But what if interest rate increases? Let's say I think this is not the correct way of describing this. Should be 2, initially 2, then it's gonna be right. So let's say initially the interest rate is 2%, then the price is going to be 2 divided by 2/3, right? And what if the interest rate has decreased from 2 to 0, right? So then if we have the price is going to be 2. So what if the price has the increased by 2%? So then it's gonna be 5.2, right? 5.2. So the one case is that 2 minus, right? The other case is that no, not this one. Okay. This one, 2/3 minus 2. And this is the case when interest rate has decreased from 2% from 2% to 0, and the second case is the interest rate has increased from 2% to 4%. Okay, so then the difference of price is going to be 2 minus 2 pips, right? So then the result is going to be one would be higher than second. Okay, mathematically. So the higher the change in interest rate is, the difference between the difference of the difference between the difference in the price changes is getting larger because of this convexity. Convex means that you have shape like this. Okay, convex. That's why it is called the convexity effect. So this is getting steeper, right? And this part is getting flatter. So when the interest rate decreases, the change of price, the increases of price is getting steeper. Okay. But if interest rate increases, the change of price decreases is a little bit flatter. It's getting flat. That's why percentage price change is greater when the market discount rate goes down than when it goes up. Understand?
Yes.
If you do? Okay, great. Any questions? Okay. And for the same time to maturity, lower coupon bond has a greater percentage price change than higher coupon bond when their market interest rate change the same amount. So the interest rate, the change in interest rate is the same. All the conditions are the same in both bonds, but the only change is the coupon rate. But if the coupon rate is lower, then the impact of discount rate is much higher on lower coupon bond. Okay, why? If the coupon rate is lower, then you have more cash flow. You have most of the cash flow comes in the at the maturity, rather than during the life of the bond, compared to higher coupon bond. Right? Okay? Let's say we have 100 par value bond, right? So the one is the 5% bond, the other one is 10% bond. So a 5% bond, coupon rate bond, supposed to pay you $5 every year, and at the last and at maturity $100, right? But in case of a 10% bond, you're supposed to $10 every year, and the last year $100, the same maturity. Let's say 5 years. 1, 2, 3, 4, 5. Yeah. 1, 2, 3, 4. Yeah, 5. Okay. So then this portion, right? This cash flow, the relative the relative weight of the cash flow during the life of this bond, the cash flow comes up faster for the 10-year bond has more faster cash flows than 5-year bond, 5% coupon bond. Why? Because it has more cash flows in during the life of the bond, but 5% coupon bond, most of the cash flow at the end of at maturity, 100. When it comes to in terms of a percentage. So if you let me use this one. Okay, this is the same principal amount. So 5-year coupon, 5-year bond. So one bond has a 5-year 5% coupon rate, and the other one is 10% coupons. So every year for 5% coupon bond, you are supposed to $5, right? And 10%, you're supposed to have $10 every year. So the total cash flow is 125, right? But the percentage of cash flows in every year takes for 5% bond is just 4%, right? And the majority of the cash flow comes at maturity, 84%, right? But when it comes to the weight of cash flow for 10% coupon bond, the majority of the cash flow, the end maturity, the rate of cash flow is just 73%. But more cash, but during the life of the bond, the coupon payment takes more weight in terms of the cash flow than the 5% coupon bond. So the discount rate, so this is the, if discount rate has more impact on the longer cash flow, right? Rather than shorter cash flow. So that's why lower coupon bond is more impacted by interest rate change. Okay, because majority of the cash flow comes at a maturity compared to higher coupon bond. Okay. So, okay, understandable? Any question?
No.
Okay. The last one is quite similar to the third one. Okay, so longer term bond has a greater percentage price change than the short term bond when market discount rate change by the same amount. Okay, so when you have a cash flow later, you're gonna have a more impact from the changes in interest rate. Okay. So this is the the primary natures of the bond in respect of interest rate changes in interest rate. Okay, this is important. Then you are supposed to solve these questions. Okay, and you should understand that this convexity. When the interest rate decreases, the level of changes, level of increases in price is higher than that of price change when interest rate increases. This convexity, especially when the change of interest rate is higher. If the change of interest rate is very small, then there's not much impact from this convexity. But interest rate changes, interest rate is a bit larger, then the impact of convexity is getting larger. Okay. So, for instance, this time the Federal Bank raised the interest rate by 3/4. Then this is a big change in the interest rate. So then longer term bonds has more impact from these changes, and the lower coupon bond have a more impact, right? Okay. If you want to know how this relationship actually plays out in the market, then please try to find and read some articles. Okay, so then you may have a more kind of better understanding when it comes to the theory and the reality. Okay. So at the end of the day, the finance should not be just theoretical. You should have some kind of, you should try to develop your ability to understand what the financial articles, the financial news broadcast actually are talking about when they mention interest rate or bond price or whatever yield. Okay, so you should have the ability to read the financial market, understand the financial market, not just the solve the questions in the textbook. Okay, that should be the purpose. Yeah, so I'm gonna. I think I think we're gonna have a chance to talk about this Fisher effect and more on bonds. I think in the later lectures. I think we're gonna have the chance to talk about more about this. So I'm gonna skip them now. Okay, so today, understanding and valuing equities. So first of all, we're gonna have some time to understand what equities are. Okay. Oh, one interesting is that after the interest rate, Fed rate increased, there's always some recessions, right? So if the interest rate goes up, keep going up, then probably 2023, 2024, at least 2024. So you may face some recessions. So right now, all the investors are concerned about the recessions after this Fed move of increased interest rate. So, okay. If you, I'm gonna. I think you guys should solve these questions after understanding this relationship. Okay. Oh, this is assignment. The both bond bills and bond tab. So can you guys deal with these questions? Just to give it a try, okay? Just give it a try, and just take take this question as a kind of deepening your understanding on on the fixed income, on the bonds. Okay, so we're gonna go back to this assignment probably early October or mid October. Okay, before midterm exam. Okay, so please try invest your time in these questions. Okay. I think this quality of audio is not very good, but I hope you. Is the Warren Buffett? I think everybody knows who he is, right?
No.
No. Oh, you don't know who Warren Buffett is? Warren Buffett is the he's still alive. He is the he's a very successful investor. So one of the top 10 billionaires in the world. So Warren Buffett is the So if you type in Warren Buffett, if you Google him, then you may know instantly who he is, right? So he's the resident investor. Okay, simply speaking.
Hello, Mr. Buffett. I got two short questions. One is, how do you find intrinsic value in a company?
Well, intrinsic value is what is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's United States government bonds, very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think is going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously. And you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you instead. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. This is a question of, isn't the question of how many analysts are going to recommend it, or what the volume of the stock is, or what the chart looks like, or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset, oil in the ground, you're laying out cash now to get your cash back later on. And the question is how much are you going to get? When are you going to get it? And how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business, because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the business increases. we can compound it internally. But the real question is, Berkshire selling for, we'll say 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets out going. If you can't answer that question, you can't buy the stock. You know, you can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies that can't answer for, but I just stay away from those. Number two.
So you got formulas involved in finding intrinsic values in certain companies. You've got a mathematical, it's a
Discounted present value of future cash. Yeah.
second short question is, why haven't you written down your set of formulas or your strategies in written form so you can share with everyone else?
Well, I think I actually have written about that. If you read the annual reports over the recent years, in fact, the most recent annual report, I use what I've just been talking about. I use the illustration of Aesop. Because here Aesop was in 600 BC. Smart man, wasn't smart enough to know it was 600 BC.
Suppose the question is about intrinsic value, right? So what is said is that the three most important thing is that the first one is the intrinsic value. It said that simply the discounting the future cash flow. So you lay out money now, then how much and when and how much is sure you can get the cash back in the future, and you discount the future cash flows at the interest rate, market interest rate. So based on that, you can based on the calculation, you can get the valuation of the security, including bonds and stock. Okay, so this is principle that applies to all the financial products. Okay, not just the bond, but also stocks and other securities. So this is the scene when the Tesla was first listed in on the Nasdaq exchange. So why Tesla listed their shares on the Nasdaq? Because they want to raise more capital to expand their business. So this is quite long ago. It looks quite young than now. So I'm not sure whether if this hair was real at the time. So the other way of raising capital is to go to the stock market. Okay. Well, unlike a bond market, stock market has its own the official market, like a Nasdaq, New York Stock Exchange, London Stock Exchange. Okay, that's the difference. So raising equal to capital, raise money. Why do companies raise capital? Why? For project by they want to raise money, capital for their own projects. Okay, so they sell a part of the ownership to the investors. So if the investors are interested in the company, then they're going to buy those shares. Okay, and then the shares will be traded in the secondary market, which is New York Stock Exchange, the Nasdaq, all sorts of stock markets. And equal instruments legally represents ownership in companies, but that instrument, like a bond, does not represent ownership in the company. It just the right. It just represents the obligations for the company to pay money back to the creditors. Okay, not ownership in the company. investor contribute capital to a company in exchange for equity instruments, and he or she will be entitled to distribution in the future. Distribution means most likely dividends. Okay, in the form of dividends, they want to get distribution from the company if they purchase and hold the equities and securities. Repayment of money is not scheduled as it would be for loans or bonds. Okay, there's no maturity. Equity instruments represent potential claims on money in the future. If the company goes bankrupt, then only after the creditors paid all the interest and principals, the equity investors is going to get the residual, any residual asset afterwards. So in terms of priority, the equity investors is behind the creditors because they are the owner. So they have their own responsibility. They take the more risks than creditors. Okay. The difference between stock from bond is that no promised cash flow, or no limited time, and hard to find required rate of return, and which okay. So then, which one of the bond or stock is riskier? Stock is more riskier than bond. Okay, and the higher risk means the high expected rate of return or higher required rate of return. So if you purchase a very kind of a newly established companies with very good ideas that has not yet been tested in the market, then if you share the shares in the company, then you want to take a lot of risk. But once the ideas of the company is successful, then you want to get a lot of return. Okay. The financial system facilitates companies raising equity capital. It's pretty obvious. Investment banks help companies issue equities, and analysts value securities that companies sell. So investment. So when the company want to issue new equities, they most likely they will get some help from outside, especially investment banks, because the investment banks has expertise in making the issuance of equity successful. Okay. Regulatory reporting requirements and accounting standards are also very important. Why? They attempt to ensure the production of a meaningful financial information needed to determine fair prices for equity. So as the Warren said that he mentioned the annual report, right? So if you I don't know, you guys know annual report. Annual report or quarterly report, right? So annual report is the contains all the financial information and non-financial information about the company. So so you can get a very detailed very detailed information of the company. So based on your reading of the information from the annual report, you can make some judgment about the company or valuation of the company. This is annual report is filed with the financial financial authority, okay, like SEC, Security Exchange Security Exchange Committee. Liquidity market help companies raise capital and the shareholders easily divest their equities and more willingly fund the reasonable projects that companies wish to undertake. So liquidity So the value of trading should be reasonably high, right? So the exchange of the securities should be good enough so that the price of the fair market value of the securities can be easily reflected in the market. Okay. Up to now, any questions? No? Okay.
No.
Okay. Equities represent ownership rights in the company, and the equities usually we mean common shares, right? When you say shareholders, we usually say common shareholders. Okay, common shares is the, in terms of priority, is in the lowest, but this is most common types of shares. Okay, that's why it's called common shares. Preferred shares is a little bit different. Preferred shares is a bit like the bond. Let's see, common shares is the common shareholder has a residual rights to any dividend. At this income statement, balance sheet. Okay. The balance sheet is the financial status of the company, right? But income statement shows the financial performance of the company, right? So every year, the annual financial performance will be accumulated on the balance sheet, right? So then these profits is gonna be distributed to common shareholders. Common shareholders. But only after the profits are first disputed to preferred shareholders. The preferred shareholders comes first, then common shareholders. So that's why it is said that residual rights to any dividends for common shareholders. The residual right to any asset remaining after all other claims in liquidation. Yes, if the company is liquidated, then creditors and preferred shareholders will have a priority in claiming the asset, and then the common shareholders come to last. And the right to select the managers who run the corporations through a board of directors. But unlike preferred shares, common shareholders has voting right. But preferred shareholders usually do not have a voting right. Yeah. Voting right means that you have the right to you can voice you have a voice about the business decisions in the shareholders meetings. Okay, if you have a voting right. Preferred shares is a bit like a bond, because preferred rights means that some preferred shares have some fixed dividend rate every year. So like interest, preferred shareholders have the title to some fixed dividends every year. But depending on the performance of the company, some years the company may not be able to pay that fixed dividend to preferred shareholders, but it is going to be carried over, accumulated. So then at some point in the future, the accumulated dividends, accumulated fixed dividends, supposed to be paid to the preferred shareholders. But unlike the bond holders, the preferred shares doesn't have any maturity. Just the difference. Okay. So generally treated as a fixed income securities. So preferred shares is usually called the hybrid securities because it is in between stock and bonds. So when we usually say stock, we mean common shares. Okay. This is about the stock market, the size of stock market. The goals of raising equity capital is well, some of the goals is to purchase a long-lived asset, huge asset, like if you want to set up a new factory, then you wanna raise capital, or to expand projects, or you may need capital to do R&D, or entry into new product geographic regions, and or merger and acquisition purposes. You need to raise capital, or capital adequacy ratio. So if you have too much debt, then debt to equity ratio may be too high, right? So then the regulatory body may require the company to reduce this debt to equity ratio. Then you need to increase the equity, right? So that's why sometimes you need to raise the equity capital. So that covenant to be met. That covenant may require, if the equity is too small compared to that, then the creditors may ask the shareholders, the owners of the company, to increase the capital injection to the company, right? Why? Because debt holders has a priority than the shareholders when it comes to claiming the asset of the company. So debt holders is going to be more comfortable with a higher, with a larger equity rather than smaller one. Okay. Any questions?
No, sir.
Okay. A book value versus market value. Book value versus market. Book value is the value you're gonna see from the financial statements. Okay, whereas some numbers may be fair market value, but mostly the value you're gonna get from the financial statements is book value. But market value is different from book value. Market value is, as the name says, that the value you wanna get from the market. Okay, so let's say where the coupon, right? Coupon. If you look at the coupon financial statements, it has its net income. It has its book value is much lower than market value. Okay, so book value is maybe about 5 billion, but market value is about 40 or 50 billion. I don't know, but at least 10 times the book value. Market value is 10 times the book value. So market value contains a lot of expectations from the company, right? So that's why there's difference between book value and market value. You guys remember the DuPont analysis?
Professor?
Yeah.
So book value is less because it is the actual assets and liabilities calculated, and market value it is something for the future, something that is planning, but not in fact already received or paid, right?
Okay, just a minute. Balance sheet, asset, liability, equity, right? And income statement. The income statement will be reflected into a balance sheet. So when we say book value means that, yeah, as you said, all the numbers from, mostly the numbers from numbers reflected in the balance sheet, financial statements. But these numbers on the financial statements is based on the historical numbers. So historical cost. So let's say you're gonna finance you need to do financing to purchase this asset, right? Through debt or equity, right? So then let's say you purchase some some equipment, right? So then the numbers, the amount of this equipment, the value of this equipment is based on the cost of the purchase price of the asset. So then you're supposed to record the purchase price of the account under the accounting regulation, accounting principle, right? So let's say you purchase this equipment now or 10 years ago, right? So then it was 100, but it doesn't change it up to now until you sell this equipment. These numbers on the balance sheet statement does not change, because but it's going to be depreciated, but then book value is going to be this purchase price minus any accumulated depreciation. That is going to be book value. So these are whole numbers on the balance statement. What I'm saying is that based on historical numbers. But the market value is not based on the accounting regulation. Yeah, when you make a financial when you drive a market value, you're gonna report to this book value, but you're gonna reflect the future expectation into this book value. So depending on the forecasting of the company, the book value is gonna go up or goes down. When it comes to market value. So market value is most likely different from book value, because market value reflects the forecasting, the expectation of the company when it comes to the business strategy or management, quality, something like that. Anything, or economic circumstances that may affect the specific companies or overall market, right? So the book value is based on usually based on historical cost. That's what makes difference between book value and market value. You understand?
I understood. Thank you.
Okay. Intrinsic value. Intrinsic value is the fundamental value of a company. So why do we need to concern with intrinsic value? Because market value, right, benefit the same as intrinsic value. Okay. Market value is the kind of the value set among the independent investors, right? So all the investors have different ideas, right? And this intrinsic value is based on your own analysis, right? So how to calculate the intrinsic value, as the Warren Buffett said, you discount the future cash flows, right? Sometimes it's going to be the same as the market value, but could be different. It could be the intrinsic value. So if your intrinsic value, true value is a higher, let's say intrinsic value is 100 and the market value currently the market price, the share price of a company is, let's say 90, then based on analysis you should purchase this bond, purchase this stock, because this is undervalued based on according to the intrinsic value 100, right? So if a market price is, let's say 120, and your intrinsic valuation says that says 100, then you should not purchase this stock, because market value is higher than your intrinsic the intrinsic value. So it means that the price of this stock is gonna decline to be true to its value in the future, right? So that's why the intrinsic value of a company is important, and how we get the intrinsic value, discount value of cash, the cash that can be taken out of a business during its remaining life. Then the key is you need to cash flow and the discount rate. Discount rate is your required rate or expected rate of return. This discount rate is affected by market interest rate or other credit risk, or some credit risks, or such of all sorts of risks related to the company. But in the end, if you if we talk about the portfolio management, at the end of the day, the discount rate is gonna be the market, depending on the valuation method, it's gonna be the market risk. Market risk is gonna be a discount rate. So I think we are going to talk about it a bit later, next time. Okay. This is just one case of intrinsic value, how to or what intrinsic value may mean in terms of book value and intrinsic value. Intrinsic value. Book value, well, about your education, be at Sawbridge or your home country college. When it comes to book value is as I said, historical value, right? So all the costs incurred during the 4-year colleges, right? Plus your opportunity cost. That is gonna be a book value, right? But intrinsic value is the difference between estimated earnings that you're gonna receive over your life after graduation, minus difference between this one and estimated cash flow over what you would have earned without college education, right? So that is the intrinsic valuation of a college education. But this is gonna be different depending on the individual. But as a whole, if you put everybody in the one basket, so then you could have some general intrinsic value of a college education. Just conceptually, okay? So the equity valuation is at the end of the day, we want to calculate intrinsic value, true value. So there are many ways to make a valuation of stock, but one is present value model, discount cash flow model, discount cash flow model. The other one is multiplier model, the market multiple models. Present value model, discount cash flow model, I think you guys are a bit familiar because we already worked on this discount cash flow method. Okay, so discount cash flow method, when it comes to weekly valuation, the name is a little bit changed, twisted, dividend discount model, because main cash flow from the stock is dividend, right? So dividend is mainly cash flow from the stock. So the name, when you apply the present valuation model, the name we usually use the valuation. We usually call the valuation discount dividend discount model, DDM. But basically, fundamentally, DDM is almost same discount cash DCF, discount cash flow model. Okay, because the cash flow of a stock is basically dividends. Okay, so this is the model we are gonna take to make a valuation of equity. A multiplier model is, as far as you guys have some interest in stock market, you may have come across some ratios like price to earnings or price per shares, right? So this multiplier model is based on some fundamental the numbers from financial statements and the stock prices. So we are going to focus on this dividend discount model at the moment rather than this multiplier model. Okay, dividend discount model. The two sources of return from investing in equities. One is dividend. The other one is change in price of equities over the holding period. But this is not realized, right? Not realized. This is realized. But in the end, the change in market price of equity over the holding period, if the dividend is not distributed, then the profits remaining in the company is going to be reflected in the price of the equity. Okay, so if you sell the equity, then all the remaining profits not distributed to you in dividends will be reflected into capital gain or loss. Okay, reflected in capital gain or loss, especially capital gain, if the company is profitable. Okay, so let's say the company has this profit. If you receive a dividend, then the value of the company is going to reduce by this amount of dividend. Let's say this is the intrinsic value. Okay, if the dividend is distributed to you, investor, then the value of the stock will be decreased by this dividend amount. But if the dividend is not distributed, just accumulated in the company, so then this value of the stock will increase, right? The profits not distributed in dividends. But then if you sell this stock, this profits will come to you as a capital gain. Okay, so at the end of the day, this is all about dividend, right? If this portion was all distributed to you in dividend, then the value of the company would be the same, right? Because all the profits are distributed to the investors. So the change of price dividend or capital gain. So the source of return from investing equity is dividend or capital gain. Dividend is the realized cash flow to you. Capital gain also realized capital. When you only make a sales of the equity, this is the realized return to you. But this capital gain also is fundamentally is accumulated dividends. Okay, the dividends that is distributed to you is gonna be realized in capital gains when you sell the equities in the market. So that's why we use this dividend discount model to make a valuation. Because if we discount this dividend, this cash flow, we can get the value of the stock. You guys understand? No?
Yes, we understand.
Makes
Yes.
sense? Okay, great. So this is the formula. Infinity. Why? Because as far as the company exists, you can keep receiving. You're gonna keep receiving dividends. There's no maturity, right? And there's no maturity. There's no maturity for stock. Unlike a bond has a specific maturity, right? So we use the capital T, something like that. So 10 years or 20 years, something like that. But we do not have any maturity for stock. That's why we use this infinity. So you keep discounting the first year, second year, right? So I keep discounting. Hey, you guys remember this? You guys remembered? Okay. Next class, next lecture. Okay, this is the formula. V1 and V0 value of a share of stock today at present value. Okay, so all the stock prices you can see, you can get from stock market is present value of the cash flows from the stock. Okay, discounted at discounted at discounted at expected return. Okay. DT is expected dividend in year T, assumed to be paid at the end of the year. Yeah, usually the dividend is paid at the end of the year. And the recurring rate of return on the stock. Recurring rate of on the stock is the discount rate. So the recurring rate of return, so as I said, the reflection of risk. So as the risk is higher, then the return is supposed to be higher. So this R should commensurate with the level of risk. Okay. Different discount model basic formula. This is present value of stock, and let's say in 1 year the cash flow is going to be, this is dividend, and this is the, as you can see, expected share price at the end of year 1, right? but we know this. We know this. We may expect this dividend, but this price is supposed to be this is terminal value. No, not this way. Just assume that we know the share price at the end of 1 year. Okay, just assume that for the time being. Then, if you want to calculate the value of the present value of the stock, then you should discount the dividend and the stock price at year end, right? So then you discount the dividend and the stock price at year end. Then you can have the present value of the stock. Okay, this price, share price, as I said, it's supposed to be intrinsic value of this stock, and this is the accumulation of all the dividends, right? All the dividends, T2, T3, right? Infinity. T21, 1 plus R, required return, right? This one. So this one would be calculated based on this one, right? But just the difference is T is gonna be start from 2. So let's say P2 is second year dividend plus discounting second year dividend and the share price at the end of the second year, right? Then you have P1. So you keep repeating this process, okay? If you keep repeating this process, then you're gonna have this formula up to second year, and then you are supposed to have this kind of formula. Understandable? Can you follow this process?
Professor, I'm
Okay.
sorry. I missed, like, with this formula, what we find?
We are supposed to find okay. We are supposed to find the intrinsic value. We are supposed to find a value based on this dividend discount model, because our purpose is to find intrinsic value, fundamental value of equity. So then we are going to compare this intrinsic value with the market value. Okay, the market value of the stock. You see, every day in the stock market, they are trading stocks. Some people buy, some people sell the stocks, right? Yesterday, they purchased the same stock. They sell the same stock they purchased yesterday. They purchased the same stock they sold yesterday. You can see a stock price in the market, but they exchange the same stock every day, which means they sell yesterday or they purchased today. Why? Because they make a valuation of the stock every day, reflecting all sorts of information related to stock. So this dividend dividend is based on the part of the profits from the company, right? But we are talking about future dividends. We are talking about future profits of the company. So every day, depending on the market circumstances, depending on market circumstances, economic situation, the future dividends is gonna change. So every company, depending on the level of impact on of the market circumstance on the company, the dividend is gonna change. So the intrinsic value, which is based on the discounted dividend value, is going to also change. So if the valuation based on the discounted dividend is different from market price of the shares, then, as I said before, if your valuation is 100 and the market price is 90, then you're gonna purchase this stock. But if your valuation is 120 and the market price is 90, then you are not going to buy this stock because you think, if your valuation is 80, then and market price is 90, then you're not going to buy this stock because your intrinsic value is lower than this market price. You know what I mean? So we analyzing the stock. We are seeking the true value of the stock based on the all sorts of techniques. So you should not just misunderstand that, oh, this dividend discount model is gonna let you know the true value of the stock. No, that's not what I'm saying. This is just one way. Could it be a one way to tell you the intrinsic value of the stock? But in reality, there are many techniques that the actual analysts refer to find the intrinsic value of the stock. They have different ideas, they have a different method, they have different techniques, and they have a different level of the information. So, but this dividend discount model is theoretically and intuitively is the most popular one. So for educational purpose, just try to get some kind of sense of what intrinsic value would be. This dividend discount model is theoretically very robust, very strong. That's why we have this model. This is just a model, just good model, right? It looks pretty, but it does not mean that it does not actually reflect the reality, right? The model does not real person. I mean, the model is real person, but the model is not always the same as the ordinary people, right? Something like that. Okay, so 5 minutes of people full. So any questions?
No, sir. I don't have question.
How about others? No question? Okay, so if you have any questions, then please email me after class. So, okay, so then have a great weekend and yeah, see you next Tuesday.
Thank you, Professor.
Bye-bye.
Weekend too.
You too, bye-bye.
Thank you, Professor.
Bisous.
Professor, I have a question.
Yeah.
So, like on syllabus, like the midterms first midterm gonna be on next week, right?
No. Sorry, I'm gonna change the syllabus. Sorry. Yeah.
Okay.
The midterm is supposed to be after UCLZ. Yeah.
Okay. Got it. Thank you.
Okay. Thank you. Bye-bye.